Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now that you understand the basics, let's go through practical steps for getting started, choosing your first investments and building a solid strategy. How to buy your first stock, a step-by-step guide. Ready to make your first actual investment? The process is straightforward once you know the steps. Open an investment account. You will need to open an account with a brokerage firm. Many reputable online brokers exist, such as Charles Schwab, Fidelity, or Vanguard. The application process is similar to opening a bank account and usually takes just a few minutes online. You'll provide personal information, including your social security number, and link a bank account for funding. Fund your account. Once your account is open, you need to transfer money into it. You can do this through an electronic transfer from your bank, a wire transfer, or even by mailing a check. Start with an amount you are comfortable losing, as even the best investments carry some risk. Research stocks to buy. Do not just pick a company name you recognize. Instead, look for companies with strong financials, a clear business model, and a history of growth. Read news about the company, check their earnings reports, and see what analysts say. Websites like Yahoo Finance or Google Finance offer free research tools. Place your buy order. Log into your brokerage account. Search for the stock by its ticker symbol. You will then enter the number of shares you want to buy. You can typically choose between a market order or a limit order. For beginners, a market order is often simplest. Review all the details, then confirm your purchase. Congratulations! You have now bought your first stock. Beyond individual stocks, exploring other investment vehicles. While buying individual stocks can be exciting, it also carries higher risk. For beginners especially, or anyone wanting broader diversification without picking individual companies, other options exist. Consider these popular alternatives: exchange-traded funds. Think of an ETF as a basket of many different stocks or bonds. When you buy one share of an ETF, you are instantly investing in all the underlying assets it holds. For example, an S&P 500 ETF holds stocks of 500 large U.S. companies. ETFs trade like individual stocks throughout the day and often have low fees. They offer instant diversification, which helps reduce risk compared to owning just a few individual stocks. Mutual funds. Similar to ETFs, mutual funds also pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Unlike ETFs, mutual funds are typically bought and sold once a day at their closing price. They are managed by professional fund managers who make investment decisions for you. Mutual funds are great for set-it-and-forget-it investing, but they often have higher fees than ETFs because of the active management. Both ETFs and mutual funds provide a simpler way to diversify your portfolio, reducing the impact if one particular company performs poorly. For many new investors, starting with these diversified funds is a smart strategy before exploring individual stocks. Essential tips for navigating the stock market as a beginner. Stepping into the stock market can feel exciting, but it's also where many beginners stumble. Learning a few core principles right from the start can save you from common mistakes and set you up for long-term success. Let's look at how to build strong habits and avoid pitfalls as you begin your investment journey. Avoid emotional investing. The importance of discipline. Imagine you are at a casino. The urge to bet big when things are going well, or to pull everything out when you hit a losing streak, is powerful. The stock market is not a casino, but it can trigger similar emotions. Fear and greed. When the market is soaring, greed might tempt you to buy risky stocks at high prices, ignoring sound judgment. Conversely, when prices drop, fear might cause you to panic and sell your investments at a loss, precisely when you should be holding on or even buying more. These emotional reactions often lead to poor financial decisions. Instead, build a clear investment plan. Decide your goals, how much risk you're comfortable with, and what strategies you will follow. Then, stick to that plan, even when your emotions tell you otherwise. Discipline is a key skill for any successful investor. It helps you stay focused on your long-term objectives rather than reacting to daily market swings. Start small and invest consistently. The power of dollar-cost averaging. You do not need a huge sum of money to start investing. One of the smartest ways to begin is by investing a small, fixed amount regularly, regardless of market conditions. This strategy is called dollar-cost averaging. Here's how it works. You decide to invest, say, $50 or $100 every month into a particular stock or fund. When prices are high, your fixed amount buys fewer shares. When prices are low, the same amount buys more shares. Over time, this averages out your purchase price. You avoid the pressure of trying to guess the perfect time to buy, which is nearly impossible even for experts. Think of it like this. If you buy coffee every week, sometimes it is on sale, sometimes it is not. But over a year, you pay an average price. Dollar-cost averaging makes market volatility work for you by ensuring you buy more when investments are cheaper. This consistent approach helps you build wealth steadily over time and significantly reduces the risk of making a large investment at an unfavorable moment. Continuous learning. Resources for expanding your investment knowledge. The stock market is always changing. New companies emerge, economies shift, and technology evolves. Because of this, staying informed is not just helpful, it is essential for long-term success. Nobody knows everything, and even experienced investors dedicate time to learning. There are many reliable resources available to help you expand your investment knowledge. You do not need to pay for expensive courses when you are starting out. Consider these options for your ongoing education. Reputable financial news websites. Sites like the Wall Street Journal, Bloomberg, Reuters, and Investopedia offer daily market news, analysis, and educational articles. They can keep you updated on global economic trends and company-specific news. Books on investing. Classic books such as The Intelligent Investor, by Benjamin Graham, or A Random Walk Down Wall Street, by Burton Malkiel provide foundational knowledge and time-tested strategies. Many others focus on specific investing styles or market segments. Financial advisors. While not a resource in the same way as a website or book, working with a qualified financial advisor can provide personalized guidance. They can help you understand complex topics, create a financial plan, and make choices that fit your unique situation. Always check their credentials and ensure they act as fiduciaries, meaning they must put your interests first. By committing to continuous learning, you will build confidence and make smarter decisions as your investment journey progresses. The more you understand, the better equipped you will be to navigate the market's ups and downs. Starting your stock market journey means understanding its basics and taking thoughtful steps. Remember, it's about setting clear goals, understanding your personal risk, and choosing the right accounts to meet your needs. By embracing diversification and a long-term mindset, you can build a strong foundation. The market will have its ups and downs, but staying disciplined and continuously learning will serve you best. Begin with what you can, invest consistently, and let time work in your favor. Your financial future starts now. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.